Okay, hello everyone, and today we have a special guest, Mr. Ralph Vins, and my name is Stan, and today we'll talk about money management, risk management. Well, Ralph is a famous authority in the field of money and risk management, the author of many academic papers, the famous trader, and so on and so forth. I'm sure that, Ralph, there's no need to introduce you, so thank you for coming here, and thank you for your readiness to share your thoughts, your insights with the trading community.
I'm very happy to, Stan. Thanks for asking me.
Okay, so could you tell me a little bit more about your today's background? What are you currently doing in sphere of trading or investing? Do you trade your own account, or maybe managing other people's money, or making systems or algorithms, or maybe you're doing some research? So what is your current background?
So I always have research going on, both in directionality with regarding the markets and systems, and always in the money management side. You know, I'm always that's the money management thing is like a little thread I had on my shirt sleeve, and I started to unravel it 30 years ago when it just kept unraveling and unraveling, and it's still unraveling. Yeah. I managed two hedge funds out of New York. One is really an indexed fund, and another one is a volatility fund, and that occupies most of my time doing that, and dealing with clients and that type of thing.
So do you make trading decisions, or are you making trading systems, creating those systems?
It's really all systemic. You know, I oversee things, and I have really a primary trader that I talk to, several times a day, and we make sure that everything is on the rails, so to speak.
So you're kind of managing institutional money, what we call the big money.
Well, family office money, wealthy families and individuals type of thing.
Okay. All right, the next question. Has your concept of optimal life changed over the years? Because your first book was written, I believe, in 90s, so it's already 20 years passed through the publication of your first book. So I understand that this is constantly evolving. You're getting new data, you're getting new ideas and insights. So has it changed over the years? And if yes, how exactly?
So it's changed dramatically in the following way. I don't think, I know there's not a trading decision we can make that is not done somehow with respect to this optimal left, this optimal point on the landscape. And I find that anything we do trading wise is reflected on a path or a location in this landscape. And Stan, I can go into this as in-depth as you want for the people on here. If you want, we could take 10 minutes.
It would be a long conversation. I understand that, but maybe
it's up to you. You tell me where you want to go with this. But beyond that, there's a number of different branches that this thing has shot off into, and one of them is with respect to our concept of expectation. Just like the original Kelly postulate, and that was a postulate, the result of that is asymptotic. That is, as the number of trades or trials approaches infinity. If we're looking at a finite number of trials, we have not only a different answer, but we need different inputs. And that gets to the notion of expectation. So let's go back to this 2-to-1 coin toss. Yeah. We have a probability of 0.5 of getting heads.
The most popular experiment.
Because it's a real world coin. There is that
exactly.
chance it could hit right on its side. It's a 1 in 1 million chance, Stan. It's going to cost you $1 million if it lands on its side.
Yeah.
Now, you think for a few minutes before you want to play it, and you get up your nerve and you go, I'll play this thing.
Well, of course not, but but in theoretical world, sometimes it will do just the same.
Let's say you're going to play it 2 times, okay? And there's a 1 in 1 million chance this could lose $1 million. Now, the classical expectation of this is negative, and hence the asymptotic result would be the asymptotic growth optimal fraction is to wager nothing.
Yeah.
But the fact is, if you're going to walk away after 2 plays, you will maximize what you expect to make. You, Stan, doing this 2 times, okay? Saying, please God, please God, please God, let it not land on its side.
I will have a little bit hard bit, but maybe I have more odds of being profitable in this game. Okay, maybe I will handle that.
You have a full tank of gas and the engine running. You're okay, right? So you're going to quit after 2 plays. You maximize what you expect to make by wagering 0.5 of your stake. Across those 2 plays. This gets into the notion of expectation, which is really the median outcome branch over a series of plays, and the classical expectation of the probability of the probability weighted average outcome. Okay, and the 2 converge. So the last year or so, I've been trying to prove this mathematically. And the other thing where the thinking has changed on that optimal F surface, we'll call it, okay, or that leverage space manifold, is that it's really ubiquitous everywhere. I mean, as traders, myself, your team, we look to maximize a geometric growth function. But there's so many things in life where you're looking to diminish that geometric growth function.
Yeah.
It could be, the growth of bacteria in a petri dish, or cancer cells in an organism, or the deficits of governments. And all of this stuff is viewed outside of outside of the lens of what we might be able to get done with it in terms of these really basic formulas. And it's very frustrating to me. I mean, for example, an increase in the variance of period-on-period borrowing by a government is the equivalent of a increase in taxes or a reduction in spending squared, okay? And this stuff is always looked at without respect to the period-on-period variance. And there's some very big gains to be had along those, looking at simply increasing the variance in diminishing geometric growth functions. And we're just not taking advantage of that. So those have been the 2 areas where this is branched off on. As a trader, I've really been far more preoccupied with the path that you take on this surface in this manifold of leverage space. That is,
yeah, I understand what you're talking about. Yeah.
Okay. I mean, any criteria you might say as a trader, you might say, okay, we always look at what system is going to accomplish this criteria. What trading approach might accomplish this criteria? And I've really kind of come to the conclusion that that question is really not germane to seeking the answer to what we want to accomplish here, but rather that criteria is solved by the path or the point we are on that surface in the leverage space manifold.
Yeah. Okay, so I have to ask you this 3rd question. Of course, when we're talking about optimal F and those concepts like leverage space and other ones, many people want to know the practical application. Can it really applied to the practical process of trading or investing or making decisions in the market? Of course, if you have any cases, maybe you told me that you manage a hedge fund today. So are you using the optimal F concept in some form today?
Well, yeah, I am, but not. Again, I have to back up, Stan. I've traded things at the full optimal amount. I mean, in like 1987 trading championship with Larry, we were doing things just flat out, gas pedal all the way down types of things. I have an account right now that's at the full optimal F amount. And but everyone is at some point on that manifold, unavoidably. Here's a good example. Let's say when you say, well, who's trading full optimal F? Well, I'll tell you who's trading a full optimal F. Anyone who is 100% in a diversified portfolio of equities. See, as the number of components in a portfolio increase, okay?
Yeah. Yes.
And as the sum of the F values of each component approaches 1, as the number of components increase, and that is at the optimal point. So if I'm running a mutual fund and I am 99% invested in stocks, I'm at the full optimal F amount. If I start borrowing money to maintain those stock positions, I've actually gone over the peak of the curve.
But if you invest with a portfolio, so you're not employing any leverage, so or you have the natural leverage of combining all these elements together. Well, for example, if you have the portfolio of stocks, like, for example, you are going to follow the S&P 500 index, or maybe you buy SPY ETF, for example. So does it mean that you are employing optimal F in this case because you have a portfolio?
Okay, let's take 2-to-1 coin tosses. Okay, if we toss it one time, we have an optimal F of 0.25 asymptotically. Okay, we're going to play it 1,000 times. Okay, we play it one time, our optimal F is 1. We wager everything. But at 2 games, 2 simultaneous coin tosses, our optimal F for each asymptotically is 0.23, the sum of which is 0.46. Okay, if I go to 3 tosses, it's about 0.21 or about 0.63 in the aggregate. And as I increase the number of games, the aggregate F amount approaches 1 in the limit at the optimal level. I could do it at greater risk than that, but at the optimal level, it approaches 1 as the number of games or number of components in a portfolio increase. So if I start levering that up, okay, I may be optimal for a short finite period. Because remember, if 0.25 might be the optimal for 1 coin asymptotically, but if you're going to quit at 1 play, your optimal is 100%. At 2 plays, your optimal is 50%. So it may be you can lever up over a short period of time and be optimal, but as the number of plays increase and the number of components increase, the aggregate F on those components is 100% investment. And so a long-running mutual fund that's close to a 100% investment is really close to optimal F over that time window that it's in existence for. So, I mean, there's a lot of people who are at this optimal amount. That may not be what the investor himself wants. You know, there's these other points on the curve that are discussed, like the inflection point or the tangent point, maybe more what the investor is looking for, which would be, let's say, a mutual fund of less than 100% investment.
All right, I've got it. Thanks.
What about, I'm not trying to be elusive. I'm just trying to be exact on it. You know, I have one fund right now that's at 100%. Okay, but I will. Part of the way I do things is because I move on a path through leverage space. As equity increases, the F value, the aggregate F value, decreases.
Yeah.
As equity decreases, that F value increases up to the optimal point. Okay, and so one of these, I'm at the optimal point right now on the volatility program, which is a very aggressive stance at this time. So, and that's one path of moving through leverage space. That is reducing exposure as things increase. It's funny because I was just reading an article from 2010, a paper from 2010, just before we got on here about a portfolio strategy that uses constant volatility. And such a portfolio strategy would be the opposite of what I just discussed with you here. That is for constant volatility, since volatility tends to increase as equity prices decline, they're shorting futures to maintain a constant volatility number on the portfolio, and it shows increased performance over that basket of stocks otherwise. And I do exactly the opposite in what I'm doing right now. But
I've got it. So Ralph, then we come into the next question. So what about drawdowns? Is it possible to use leverage space, the concept of leverage space, optimal F, to mitigate risks, not to maximize equity? But because many people manage other people's money, for example,
right.
They want to do that in the future. And when you trade other people's money, the investor is very much concerned about risks, so they may not search for larger gains. But when you are able to maintain the smallest drawdowns possible, possibly you will be called a good money manager. So is it possible to mitigate risks and to manage drawdowns? It's a completely different topic, I understand, but
right.
maybe you have your own view on that topic.
Well, I think to start with, if we go back and say, well, if the only way I can die by being struck by lightning, eventually I'll die by being struck by lightning.
Yeah.
That point tells me that no matter what I'm doing to mitigate risk, it may not be enough. So let's start with the idea of diversification. We know in like 2008, okay, or anytime things go south, things tend to increase in their correlation to one another. So diversification really is not a way to mitigate risk, but it helps us not miss out from a big move in one of the components that we're in to the upside.
Just that, right.
Yeah. Now, for a long time, I thought, well, it's very possible to mitigate risk on things by using put options. And I still think that's a great idea, to totally truncate tail risk.
But they're overpriced, no? When the market is not so, when the risk appetite is not so slow, the put options may cost you money as an insurance.
Right. But I'm saying, let's say we're buying put options as a constant protection down there. So we're working our way in there. We buy them on days when things are going, up nicely and things are bid down.
Yeah.
But even at that, it's very possible that the put option may not be honored. And it may be, say, on an ETF that dissolves. Now what are you going to put to people? And this has really not been tested on whatever it is that you're trading. It might be tested on something else that someone else created. But, people do funny things. And people do funny things in markets when things melt down and the rules change. And so, again, I go back to, if the only way you can die by being struck by lightning, eventually you'll be being struck by lightning. Keep away from lightning. In other words, no matter what you're doing to mitigate risk, and I like the idea of put options, but I also acknowledge that, even that may not hold up, okay? What is it? The best laid plans of mice and men often go awry, right? So I'm a mouse. All right, but I think it gets to the crux of what I think a lot of questions along this line are, Stan, and that's this. And again, I am a big advocate of truncating tail risk with put options and putting them on judiciously at the right time, because much like insurance, it's never really overpriced relative to, you're buying insurance is what you're buying. You're writing that money off. Hey, it's going to burn out and hopefully I never need it, right? And you always kind of begrudgingly do it, okay? Yeah. But at some point, you may get tagged here. And like any approach in the markets, and this really gets to the core of the discussion, there is no way to do this and be comfortable at it. Whatever approach someone takes to the markets, or whatever approach they take to mitigating tail risk, requires patience and nerve, no matter what it is, because even the safest strategy, you still have that, you've got something hanging out, and you're gonna be nervous about it. It's gonna be uncomfortable.
So you have a tail risk for every strategy which might seem safe.
You have a tail risk in T-bills.
Yeah.
You know, I mean, there's a tail risk out there, but not just on the risk aspect. In terms of implementing any approach to the markets, I don't care if it's a moving average, a fundamental approach, anything will require patience and nerve of people. And 99.9% of the people I talk to, Stan, they're looking for a way to do this comfortably. And there is no way to do that. And that pursuit of comfort will give you a really bad set of criteria that you're going to want to satisfy. I think as soon as guys accept that, this is going to be getting on a bull and going for a ride here, and it's not going to be comfortable. It's going to take patience. I call it walking naked through the car wash in February, because that's a lot what it feels like. Okay.
Yeah. Okay.
It is not comfortable, and it takes a lot of nerve, no matter what approach we have, and that also acknowledges that this risk does exist out there. And if things do blow apart, let's say this put strategy I have on doesn't work. Okay, now what have I got in my bag here? Now what am I going to do? And I think it's good to think that stuff through beforehand, because these things have a way of, worst case events have a way of sneaking up on us. You've been around long enough. You've seen enough crazy markets in the time you've been around. You've seen more crazy markets than 90 some odd % of the people doing this, Stan.
Yeah. All right. So thank you for the answer. It might be more sophisticated than many listeners might expect, but that's it is. All right. Another question, Ralph. As algorithmic traders, we employ the set of trading systems which might not correlate one with each other. For example, one may be momentum trading system, other is mean reversion trading system. Well, for example, a set of 3 to 4. May we somehow use this leverage space concept to define the best, to define the share of capital which we allocate to each trading system, not just one managing risk within one trading system, deciding what risk size to choose, but rather defining what trading system to assign more capital to. So, because trading system is something different from, it has certain parameters like profit factor, recovery factor, and so on and so forth. So typically now we are choosing systems using by the performance metrics. Okay. So we are defining some parameters, and we decide that this system is okay. It does well in the current market. So maybe there's another way with the help of optimal F, leverage space, and other mathematical things which you normally describe in your books.
There certainly is. I mean, I strongly believe in allocating things per a leverage space manifold on those things. If I have 5 different systems I'm looking at, we have a 6-dimensional manifold in leverage space. But again, it gets back to, okay, so where on the surface in that manifold do we want to be? And not only where, but do we want to move around? Do we want to traverse a path through that with respect to time? And it gets back to criteria. What are we seeking here?
Yeah, that's why I've asked you about the drawdowns previously. For example, if we want, let's say, to maximize our Sharpe ratio, the relationship between the profit and the drawdown. So for example, we put it as a criteria. The Sharpe ratio is our indicative criteria, which we want to have the best of what we can have. Okay. That's just, for example, Sharpe ratio. Is it possible to having this criteria in mind to define the best risk size for each trading system?
Certainly. So let's say, in fact, I could probably show it graphically if you want me to share the screen.
Yeah, certainly.
Sure. Okay, so give me 1 second here and I'll find it. So let me see here. Okay. So that's a terrible picture, but this is our 2 coins, say, okay? Here's the F on, we're trading 2 coins simultaneously. Here is the F on 1 coin. Let me find a better picture to understand. Let's see. Those are black and
Is it
white.
three dimensions?
Yeah, I know it's all black and white. It doesn't just show. It doesn't show up nicely. All right, let's see.
Okay, that's colorful.
Okay,
that's
so
more,
here's much better.
visual.
Okay, so here we have 2 coins. Here is the multiple we expect to make after 20 plays.
Yeah.
Okay, 20 simultaneous plays of flipping 2 coins, and the axis along the floors, along each wall on the floor here, is the allocation to each coin. So the peak is at 0.23, 0.23 in this case, or very close to it after 20 plays. And the interesting thing is the gray area is all area where you lose. The multiple's less than 1, you're losing on that. So if we say, oh, we're going to put a constraint on here of a Sharpe ratio it has to be at least such and such, okay? We're going to end up removing space on this thing. Let me find a good picture here. There's good pictures out here.
Is it from the book?
Yeah, I'm looking. There's got to be some good pictures here. Here we go. Right, so let's suppose we remove some space on this, and now we're looking at something like this, okay?
Oh.
So let's spin around and look at this from above. Now we're looking from the top down, okay? So the blue area is area that's profitable on this 2-to-1 simultaneous coin toss. And the gray area is loss area, okay?
Yeah, I see.
So once we put that constraint on, we have really a very small amount of potential F values for both, potential sizes for both that can work out to be profitable for us in this case. And so that's one criteria. We may have multiple risk criteria on here. We say, oh, and drawdown no greater than 20%. That may eliminate more space. Generally, the space in the 0, 0, this area here would be the 0 on coin 2. That's 100 on coin 2. So around the 0, 0 mark generally is where you'll find the most blue space. The less you risk, the less chance you have of getting hit. And so it may be that you want one spot along there, or it may be that you may want to traverse a path through this 0, 0 space somehow to accomplish what you want to accomplish. I myself, in what I'm doing, tend to travel, as equity loses, I tend to travel more in a direction towards the peak. And as equity is gained, I tend to travel in a direction away from the peak. This has the effect, by the way, of smoothing out the equity curve some. And interestingly, portfolio insurance, which seeks to truncate loss, it tends to recreate a synthetic put on the portfolio itself, moves in the opposite direction. It is, as equity decreases, it moves towards 0, 0, and as equity increases, it moves towards the peak.
do you advise to use special, I don't know, special software to calculate this, or we may use the regular, I don't know, toolkit like Python or R maybe to calculate that?
So a lot of what I do in calculating this, Stan, a lot of what I've been working on lately is, because it is mathematically very intensive, right? It's computer intensive and so forth. And yeah, you could run 50 servers in parallel on AWS and so forth and calculate things a lot quicker nowadays. But because we're talking about what's going to happen in these markets in the future, not necessarily in the past. And we know that there's going to be some difference there. And so I want something that's more robust, and I'm looking for a more robust way to duplicate that surface, or at least what I expect that surface to be in the future. And part of that is, I know that the best guess I can make of where the peak in that surface will be, let's say if we're trading just one component, the best guess for the peak will be the probability of winning periods over that time window in the future divided by 2. And I mean, I can make a good mathematical argument for why that would be the best guess. So let's say I expect half of the winning periods in the future, half of the periods in the future to be winning periods, or let's say 2/3 of them to be winning periods. So if I take, 0.66 divided by 2, my best guess for the peak of that system is at 0.33 allocation to that system, okay? It's very simple, but I think if you went through all the gymnastics, all the mathematical and computational gymnastics, you might come out 0.25 to 0.4 over historically, and that doesn't mean it's going to come in right there tomorrow. So I think that these robust ideas of measuring where you are on the surface are very, very valid. At least my experience over the last few years is, these seem to hold up pretty well. When you start combining things together, let's say I'm looking to combine 2 systems or 3 systems together. You can divide that 0.33 by however many systems you have. Let's say you have n systems. Let's say I have 3 systems. I could say, okay, then 0.11 to this system.
Yeah.
If they are not correlated at all, or rather if they're perfectly correlated, I would put that at 0.11. If they're totally uncorrelated, I could leave it at 0.33. But what I generally do is I will divide that number by the number of systems I'm looking at, solely because, and this gets back to the risk question, when things really go to hell, they all go to hell together, generally. Yeah. If you have one that doesn't, count your blessings, but I want to be able to survive things when everything goes against me, because it's just a matter of time till that day transpires where they do all go against me. So how am I going to survive that? And so what I really do is, as a very robust means of looking at this, is of the surface, I take for one component, one system, the probability of what I expect the winning periods that I'm using in the future, I'm going to trade this, and just divide it by 2. And that's a very good proxy. And I will further divide that by the number of components I'm looking to trade, simply because I want my footing to be solid enough to survive those really bad days, those really bad periods.
And maybe the last question, to not consume your time too much. The rise of algorithmic funds like Two Sigma and Renaissance Capital, for example, they created a popularity of quant traders. And how do you think? What do you think about deep machine learning and neural networks and all that new stuff, which is now popular among investors? So everybody wants to learn Python in financial industry. So what do you think about that?
So in the early 90s, guys started talking about neural networks as some type of holy grail. And I mean, and clearly they have their applications in AI and so forth.
Yeah.
And mean, I think we're trying to replicate what human beings do, but on a larger scale. It's probably a valid approach, but in the end, what you make or lose and the shape of your equity curve is going to be determined by where you are in leverage space. And whether you're able to employ any strategy at all gets back to a function of patience and nerve. I hate to bring it to that, but it's those two qualities so few people really have. I have no interest in comfort in this. This is not an exercise in comfort. And as soon as I start seeking comfort, I'm in trouble. And I think that's a real pitfall for a lot of strategies is we conflate comfort with profit, especially when we look at things with respect to risk.
Yeah.
And, you know, I've known guys and I've traded with guys at other institutions who, you know, they want to keep their jobs, so they trade very lightly. And we have a lot of funds right now that do that. Okay, people complain about fees, but that's because people are trading things in quantity nowadays that back in the 1980s, we would have fallen on the floor laughing at. Okay, the world has become very fear averse. It's a bike helmet, water bottle world. Maybe not so much in Russia, because you guys have some freedom going on there that's the envy of the world, okay? But the rest of the world lives in fear. And this fear is part of what's driving this bull market, by the way. This fear is why money managers are trading much lighter quantities than they should be, and people are bitching about paying the fees they do for the returns they're getting.
Yeah.
I think it is a pursuit of comfort.
Yes, so everybody seeks comfort. Then I
Yeah.
have to ask you of how to develop this nerve and this psychological robustness.
No, but it is, and that becomes a big question. It really does, and I think it's important to have ourselves psychologically prepared to go through this. You know, I know, hey, today's going to be a tough day. It's just I know what I have to do. I have to hang in there and do it, and it's going to suck and it's going to hurt, and if I can keep, you know, the longer view of things, which, I mean, for me right now, the longer view of things might be 4 or 6 months out, and that is what will satisfy my criteria. If I start looking for ways to get comfortable, I want to get cute, I want to hedge a profit just before the market takes off, it leads to all kinds of problems. And I think being consciously aware of the allure of comfort in doing this is a great first step, and something no one ever talks about. Because we look at guys who are doing well in the market as they're able to do it, and it looks effortless and it looks comfortable. And as long as I'm comfortable at this, I must be doing something right. And nothing could be further from the truth. And you know that. I mean, some of the best times you've had have been after the most uncomfortable times in the markets.
Yeah.
You know?
Yeah, I understand that. Yeah, the most profitable trading is associated with something not related with comfort at all.
Yeah,
right?
Yeah.
And
I wish that weren't the case. But
one question from my friend about risk management, as to you as an authority in the field of risk management. Well, most people treat losses or risk not personally, so they treat it virtually, like something creating outside. And there was an experiment when traders were charged by real people when losing money, when betting too much on a trade. So they surprisingly became disciplined and focused. So this phenomena exists when the market is something that exists outside, something not here. But when you are obliged to give your money to someone else, maybe your friend, maybe your the trader next to you, so you become very disciplined and focused. So that's a phenomenon. So does it make sense, you know, this concept of being charged for making wrong decisions to someone else? It's like you having skin in the game, you know?
Absolutely. You know, when I worked for Larry Williams, and this was kind of a revelation to me, you know, I was in my early 20s, and he would come to me and say, and again, we were at a time zone that was bad hours too, and it'd be, I want you to trade this system in T-bonds. Here's what you're going to do. Here's the level of aggression you're going to do it. Go ahead and do it. And we did that in the trading championship, right? And he mentioned off the cuff to me, he said, well, I'll give you, 5% of the profits in this account or whatever. And I totally discounted that. It went in one ear and out the other. I totally forgot about it. I said, okay, this is my job. The guy's paying me. I get up at 5 o'clock in the morning. I do my calculations. I call the brokers. I put in the orders. Boom, right? Order gets filled. I do this. I do that. That's my job. And we were doing things at a full F level. Now, if you stop and you think, if I'm going to do that for myself with my own money at the full F level, and I'm watching my P&L going, it becomes very uncomfortable in a hurry. When you have some young kid who is just doing it as a job, who his criteria is not to screw up. That's it. Just follow the instructions and don't screw up. It is amazing how close you can match what the system is supposed to do in a way that to do that personally with your own money or with clients' money is very, very, very difficult. Very difficult. Granted, some
because you
people
don't
are
have
emotionally
much skin in the game, right? When you put your own money at risk, that's a totally different game.
It changes things. It does. It just changes the whole perspective on everything. It makes it a lot harder.
Yeah. Okay. I've got it. Thanks. And finally, in the end of our interview, I want to ask you about Larry Williams. Do you keep your relationships now? Maybe you call by the phone or socialize or communicate somehow now?
We talk every few weeks at least. And I just spoke to him yesterday. I know he's in Montana. He was going to a rodeo last night. I know they do that in Montana. They go to rodeos. I've never been to a rodeo. But
do you work on something together now?
We talk about the markets and we actually exchange ideas still. He's always got great ideas, this guy.
So who else had the same influence on your mindset, on your thinking like Larry Williams had?
So there's a fellow named Tom DeMark. And I'd been in touch with him going back maybe 30 years and John Bollinger as well. And these are guys who really had a profound effect on me. Another guy who had a big effect on me was a guy named Rich Wilkie, who I have doing my, implementing my trading today, who I work with at the Abu Dhabi Investment Authority, who probably had more consecutive winning trades than anyone I've ever met. Trading a risk-based, not in our program, but a risk-based program. He had over 400 winning trades at one time. This is legendary stuff. Very, very sharp guy, very quiet guy. He would never talk to anybody. In fact, he'd get angry if anybody tried to get a hold of him. But he and I worked on a lot of things together over the years. We worked together in the Middle East 20, 25 years ago. We've stayed in touch, and he's had a profound effect on things.
Yeah, I see that. Okay. Thank you, Ralph. Thank you very much for the great talk, for the great discussion.
So, have a nice evening.
Have a nice day too. So, okay.
Thank you.
Bye-bye. Thank you.
Bye-bye.